In the world of finance, the Dow Jones Industrial Average has been hitting the headlines, soaring to its highest point of the year. Closing November at 35,950 points, the Dow has certainly been dancing to a new tune. But what's behind the music? Well, it's a symphony of factors. First and foremost, we have some strong economic data. Reports of rising consumer spending and falling unemployment claims have given investors a confidence boost, encouraging them to put their money into the market. This positive economic data has been a key driver of the Dow's impressive performance. Then, there's the holiday shopping optimism. With the festive season just around the corner, investors are banking on a surge in consumer spending. This expected increase in shopping activity can benefit companies across various sectors, from retail giants to tech firms, and consequently, buoy the Dow. Another significant factor playing into this rally is the interest rate stability. The Federal Reserve, with its decision to keep interest rates steady, has provided a sense of calm in the market. This stability encourages investment as it reduces the risk of sudden financial downturns. So, what does this mean for the market? Well, the Dow Jones Industrial Average is a key indicator of the US stock market's health. When it rises, it often signals that the economy is on an upswing. This can be great news for investors, as it suggests that businesses are performing well, and their stocks could see increased returns. However, it's important to remember that the financial market is a complex beast. While the Dow's current performance is certainly impressive, it doesn't necessarily guarantee a sustained market climb. There are always risks involved in investing, and it's crucial to keep an eye on various economic indicators and not just the Dow. While it's too early to predict a sustained market climb, the positive momentum certainly paints an encouraging picture. As we move forward, it'll be interesting to see how the Dow Jones Industrial Average performs. Will it continue to hit new highs, or is there a slowdown on the horizon? Only time will tell. On a less positive note, banking giant Wells Fargo finds itself under the spotlight for all the wrong reasons. A recent lawsuit has surfaced accusing the bank of failing to pay overtime to hundreds of its employees. The case alleges that Wells Fargo implemented a policy of understaffing its branches, leading to employees working excessive hours without receiving the overtime pay they are entitled to by law. If this allegation holds water, it could signify a grave violation of labor laws, and naturally it's a situation that's causing quite a stir in the financial community. But this isn't just about the additional money that should be in the pockets of hardworking employees, it's about the potential impact on employee morale and well-being. We've all heard the term burnout, right? It's a state of emotional, physical, and mental exhaustion caused by excessive and prolonged stress. It occurs when you feel overwhelmed, emotionally drained, and unable to meet constant demands. This lawsuit raises important questions about whether Wells Fargo's alleged practices could contribute to such a state among its employees. The implications of this lawsuit could be far-reaching, not just for Wells Fargo, but for the broader financial services industry. It serves as a stark reminder that corporations need to be transparent and fair in their compensation practices. Employees are a company's most valuable asset, and they deserve to be treated fairly and with respect. Should this lawsuit prove successful, it could set a precedent for similar cases in the future. Other companies may be prompted to review their own practices to ensure they are on the right side of the law, and rightly so. This case also shines a light on the role of regulatory bodies in enforcing labor laws and protecting employee rights. It's a delicate balancing act, ensuring companies can operate effectively and competitively while also safeguarding the rights and well-being of their workforce. This lawsuit highlights the importance of transparency and accountability in employee compensation practices, a lesson that all corporations should heed. As we continue to track this story, it will be interesting to see what ripple effects it may have on the wider financial industry. Stay tuned for more updates. Let's delve deeper into the Dow Jones's recent success, examining the factors that led to its impressive rise. Firstly, positive economic data has played a substantial role in boosting investor confidence. The recent rise in consumer spending, coupled with a decrease in unemployment claims, paints a picture of an economy on the mend. As more people find work and have disposable income to spend, the companies listed on the Dow Jones stand to benefit. This, in turn, propels the index higher. Secondly, the holiday shopping season has always been a crucial period for many businesses. This year, the anticipation of increased consumer spending has added a significant boost to the market's momentum. From tech gadgets to home appliances, holiday shopping often drives up sales across various sectors. As these companies' revenues increase, so does their stock price, pushing the Dow Jones to new heights. Stability is another key factor in the Dow Jones' recent rally. The Federal Reserve's decision to hold interest rates steady has provided a sense of security for investors. When interest rates are steady, borrowing costs remain predictable, which encourages businesses to invest, expand, and hire more workers. This positive cycle feeds into the stock market, uplifting the Dow Jones along with it. But what does this mean for the broader economy and the financial market? Well, a thriving Dow Jones can signal a healthy economy. It suggests that companies are performing well, which can lead to job creation and wage growth. On the flip side, it also means that any potential downturn could have a widespread impact, given the interconnectedness of today's global economy. It's also worth noting that the stock market isn't the be-all and end-all of economic health. It's just one piece of a much larger puzzle. Other factors such as wage growth, inflation, and housing affordability also play a crucial role in shaping the economy. As we move into December, financial enthusiasts will be watching closely to see if this positive trend continues. Turning our attention back to Wells Fargo, let's examine the potential repercussions of the overtime allegations. This lawsuit, if proven, could have a profound impact on Wells Fargo, and indeed, ripple effects throughout the entire financial services industry. Firstly, let's consider the financial implications. The bank could be looking at significant fines if found guilty of labor law violations. These penalties can be hefty, designed to discourage such practices. But the financial impact doesn't stop there. Legal fees, settlements, and potential back pay to affected employees could all add up to a hefty bill for the banking titan. However, the repercussions extend beyond mere financial penalties. Wells Fargo's reputation could take a severe hit. In an era where corporate responsibility and ethical practices are scrutinized, allegations of this nature can tarnish a company's image, possibly leading to a loss of customer trust and loyalty. This erosion of reputation could potentially translate into a loss of business, which could have a more lasting impact than any immediate financial penalties. The lawsuit also raises questions about Wells Fargo's internal practices and culture. If the allegations are proven true, it would necessitate a thorough review and overhaul of their compensation practices. This could mean changes to staffing levels, working hours, and overtime policies. Such changes could disrupt operations and require significant resources to implement. Moreover, this lawsuit could serve as a wake-up call for the financial services industry at large. It highlights the need for transparency and fairness in labor practices. Other banks and financial institutions may find themselves reviewing their practices in light of these allegations. In conclusion, the potential repercussions of this lawsuit for Wells Fargo are significant and multifaceted. They range from immediate financial penalties to long-term reputational damage and operational changes. The outcome of this lawsuit could have far-reaching implications, not just for Wells Fargo, but for the entire financial services industry. As we wrap up, let's summarize the key points from today's discussion. The financial world is a complex landscape filled with peaks of success and valleys of challenge. The recent events surrounding the Dow Jones and Wells Fargo perfectly exemplify this. On one hand, we have the Dow Jones Industrial Average, hitting its highest level of the year in November. Strong economic data, holiday shopping optimism, and interest rate stability have all played a part in this impressive climb. The positive momentum is certainly encouraging, and it paints a picture of a market that's continually evolving and adapting. But on the other hand, we have the serious allegations against Wells Fargo. Accusations of unpaid overtime to hundreds of employees raise critical questions about fair compensation, corporate responsibility, and employee treatment in the banking industry. The outcome of this lawsuit could significantly impact not just Wells Fargo, but the financial services industry as a whole. These two contrasting stories serve as a reminder of the dualities within the financial world. They show us that while the market can reach new heights, it's also essential for corporations to uphold their responsibilities to their employees. They remind us that a thriving market doesn't necessarily mean all is well behind the scenes. In the world of finance, every action has a reaction, every decision has a consequence. The Dow's rise may spark optimism, but it's also crucial to remember that such success should be built on a foundation of fair practices and corporate responsibility. As we move into December, the unfolding of these stories will continue to shape the financial landscape. They offer invaluable insights and lessons for corporations and investors, serving as a reminder of the complexities and challenges inherent in the financial world. As these stories unfold, they will continue to shape the financial landscape, providing valuable lessons for corporations and investors alike. Stay tuned for more updates, and don't forget to like and subscribe for more engaging financial content.